as an investor, I'm always pushing for a higher loan to value ratio. And why is that? The reason that is that extra interest on the purchase can be tax offset. The cash I put in cannot. Today, it's about loan to value ratio, LVR in mortgage broker terms. An LVR implies how much of the loan or the asset the bank is going to pay for or lend you for, and how much you're going to pay for with your own cash. Generally speaking, you'll hear about an 80% LVR loan, which is you put up the 20% deposit, the bank lends you the 80%, and then you go from there. That is the most conventional form of lending applied to a demographic with lots of cash with them. But there are different LVR products out there. The reason why the 80-20 LVR is so popular, because it avoids something called lender's mortgage insurance. That's an insurance that protects the banks that should you default, 20% of the equity is covered by that insurance to make sure if they need to do a fire sale on your asset, they can get at least 80% of their money back. Now, let's go through the LVR and how it works for you. First criteria, how much cash do you have? Now, if you have $200,000 in cash and $1 million property purchase, does that mean you have an 80% LVR that you're trying to seek from the bank? The answer is no. Because you still need to pay for the stamp duty. You still need to pay your legal fees. There might be some application fees associated with it, costs associated with the purchase of the house, which drives back that 20% component. With your stamp duty, for example, on $1 million purchase, that's almost $30K gone right here, right now, leaving you with $170. Legal fees, call it $2,000. All in, you're probably looking at an LVR of 85% in this scenario. But do you want to put all that money in the property? What if the property needs some renovation? What if you want to maintain some cash in your account for the rainy day fund? Is it always best to go 80% LVR? Or do you use the LVRs that the different banks have to make your situation more comfortable? It all depends on you. As a business owner, generally, I'm kind of forced to use the 80% LVR rule because banks don't trust business owners as much as they shouldn't, because statistically speaking, most businesses fail in the first 10 years. So it's important for a bank to minimize its risk, and the way it does that is by giving less of a loan to value ratio. But as an investor, I'm always pushing for a higher loan to value ratio. And why is that? The reason that is that extra interest on the purchase can be tax offset. The cash I put in cannot be tax offset. You are not making money off the cash. You are making money off the asset. The cash is there to protect the bank, not to improve your position. My ideal scenario is to keep as much cash in my back pocket as possible to save for the rainy day funds. I very rarely buy existing properties. I mainly buy house and lands. I mainly buy small development sites. So I need my cash to help me pay for the interest, pay for the repayments, help pay for the hurt money of getting the development started, to make sure that I'm comfortable, to keep the bank safe and myself comfortable. You do not want to put pressure on yourself. So I would, if I could, go to the maximum LVR. In fact, I established my high LVR product for people like me and people like you who either A, don't have the deposit, or B, have the deposit but would prefer to keep it in their account to make sure they're comfortable in repaying it as they grow the situation, to make sure that rainy days do not get me wet. It's critical for me in most investment strategies to keep cash in my pocket for tax reasons, for comfort reasons, and to make sure I never default. Now, if I'm going for a higher LVR, which means a 90 to 95% lend, then yes, I do have to pay a lender's mortgage insurance, which is a cost on my actual purchase, which I have to make back when I sell. So I have to be confident on that. It depends on the strategy I wish to use. There are things from 80% LVR, 85% LVR. That's where it maxes out in the low doc, which means a business person buying a property without showing their financial documents. 85% is kind of the extent of it. But then there's a 90% and a 95% with conventional non-banks. We go up to 105%, which is 100% of the property purchase and just 5% for the LMI and risk fee, requiring you to come up with a stamp duty. The less money you put towards the asset, the more deductions you get, but also more importantly, the more you have in terms of safety. But also the higher the loan to value ratio, the higher the risk for that bank. So the more paperwork they're genuinely going to ask you for to protect their money. It's always about what's best for you and what the asset is doing. I'm going to give you a live example of a friend of mine who bought a fixer-upper to live in. The bank told him they could go up to 90%. He was going to put all of his cash into the deal. It was a day before settlement. He was going to be left with $70K cash because he felt that that was going to be required for the renovation. My instruction at that time as a friend, not as a broker, was do the highest LVR you can, keep the cash, put in your offset account to make sure that you are comfortable, because sometimes renovations go a little bit haywire. They made that move 24 hours before. The bank accommodated because they had already had him approved. He settled. He kept $200K thereabouts in his bank account. The renovation cost $170, not $70. Had he not done that, he would not have had a complete house. He would not have had a complete investment. Now that investment is worth substantially more. Understanding that it's not as clean cut is critical to you. It's always about the goal and how much cash you have and how much cash you need. Leverage the LVR products according to your situation. Don't just go high because I said to go high. You may not need that cash. Don't just go low because you have the cash. Make it relevant to you. Maybe you want a property that gives you positive gearing. Maybe you want a property to give you income, which means you need more deposit, which means you need less of a lending LVR. It's all relevant to you. Get involved. Do what's necessary to understand it. Talk to your broker. Talk to us here at Empower Money, at White Picket Fence. Everyone can help you get there. Do not rely purely on yourself, guys. We have professionals for a reason. We do not diagnose ourselves on Google. We do not diagnose ourselves on ChatGPT. We go to the source who understands this day in, day out. That concludes day 2. Subscribe for more. Every day, tips and tricks are going to be coming to help you get better ahead in your finances and understand the Australian system, which God helps us needs understanding as they constantly screw and change and make the opportunities less and less for everyday Australians trying to get ahead. Guys, we are getting thousands upon thousands upon thousands of views a day. Please like, subscribe. If you're loving the content, press the notification button. Jump on board. More free advice just for you.